If you've been waiting for the right time to jump into multifamily or even double down on your multifamily portfolio, this is the video you have been waiting for. Guess what, guys? Occupancy is up, rent growth is returning, and the construction pipeline is drying up fast. I'm Matt Faircloth from the DeRosa Group, joined today by our acquisitions and marketing expert, Hervé Francois. Hervé, how are you today, buddy?
Doing very well, Matt. Real excited to be here.
Hervé and I are going to be breaking down the biggest shifts in multifamily real estate during the first half of 2025 and what we believe is coming in the second half of 2025. And hey, guys, if you're wondering what it means to be a local market expert, maybe you're a local market expert and don't even know yet. A specific deal you're looking at might be something you want to check with the local market stats. So, to get our free market analysis tool that'll tell you if the market you're operating in now, market you're considering, meets the checklist that DeRosa's created and maybe is a market that's poised for growth, be sure to download our free market analysis tool. This tool is developed by Hervé specifically for you to go and determine the right markets and maybe wrong markets that you guys are looking at. It's the same framework that we use for vetting our deals. So get the link in the comments down below and get that tool so you guys can evaluate your markets that you're considering investing in. In this video, we're going to cover 4 key drivers when you're looking at a deal and a market. That is market occupancy, absorption, new deliveries, and rent growth. Hervé's going to walk us through what changed in Q1 and Q2, and then we'll dive into where we are headed next.
But let me tell you a little bit of a spoiler alert here where market fundamentals are changing. When you take a look at occupancy, we are now at 91.8%. That was as of the first quarter 2025, and it's slowly moving up. That's a major change from the past couple of years, a major change that we have seen over the last 18 months. And if you play your cards right, understanding exactly what's driving this change, what's driving the improvement in occupancy over the past 18 months, you're going to set yourself up for success over the next couple of years. We saw a big turning point in the first quarter of 2025, and we think that's going to continue over the next several quarters.
That's crazy, Hervé. I actually didn't realize until we were preparing for this video that market occupancy had increased. We took a major beat down in 2023. And I'll bet you a lot of viewers don't realize that the national occupancy rate has actually been increasing. And so now the sentiment of multifamily is not there, but the economic drivers appear to be turning around.
What's been going on is that absorption has really been picking up, and that is just a strong base of the underlying strength for apartment demand. We saw about 130,000 new units absorbed in the first quarter alone, and that was absorbed in cities like New York City, Dallas, and Phoenix. Now, it's interesting that you have a Northeast city in a list with some typical strong Sun Belt markets, but it's for different reasons. You can argue the absorption in New York City is because, believe it or not, there's been a lot of demand and strong growth in New York City for apartment units. They have been undersupplied, similar to other Northeast cities in the past couple of years. But when you start talking about cities like Dallas and Phoenix, they are finally beginning to absorb a lot of the oversupply that has been put in those cities over the past couple of years that caused rents to decline in those cities last year, as far as about, like, for example, -8% in a city like Austin, -6% in a city like Dallas last year. That rent decline is beginning to abate to the point where you're beginning to see small, not big, but smaller rent growth appear in some of those Sunbelt cities.
So you think that the data is showing that there's been absorption of all these new builds because, Hervé, what pushed rents down and hammered a lot of these markets, like you said, Phoenix, Austin, Dallas, was overbuilding. There were too much supply coming into those markets. So you're seeing data that is showing that all those new builds are starting to get absorbed, huh?
Yeah, absolutely. And that data is unequivocal, okay? Yes, the strongest rent growths in the market right now are markets in the Northeast as well as in the Midwest, because those two markets, they did not get hit with the oversupply like the cities in the Sun Belt markets, the ones that we were just mentioning, right? So you start seeing very strong, I would say, mid-single digit, almost high single digit growth rate in the Northeast and the Midwest when it comes to rent growth. Why? Again, not hit with oversupply. So they're not necessarily in big time absorption mode as the cities in the Sun Belt where they're just soaking up. The good thing about some of these Sun Belt markets, oh my gosh, look at -8%, 6% rent growth last year in those markets. The good thing that's benefiting those markets, and you touched upon it a little bit before, is the job growth. The job growth is still very strong in those same markets, and that it is what's contributing to the absorption of the new units that have been put into those markets over the past couple of years.
Hervé, that is really interesting. And so what I've heard, and we've experienced this too at DeRosa, that it's interesting to see all these new builds getting absorbed that were
Yep.
started several years ago.
Yep.
What's interesting though, it's economically difficult. It's darn near impossible to build a new multifamily today. Right.
Yep.
And so I've heard that although a lot of these multifamilies that got built a few years ago are being absorbed, not many people are starting new multifamilies. Is that the case that you're seeing in the data as well?
Yeah, absolutely. That same data, Matt, is showing that new deliveries were down 30% in the first quarter, only about 130,000 units delivered. Again, down 30% in the first quarter. And there are reasons. The research shows the reasons behind that decline in new units from developers. And it's the obvious ones, right? It's the high construction costs, both labor and material. It's also shortage of labor. It's also high interest rates and stricter lending requirements from lenders who over the past couple of years are now having to deal with potentially properties coming back to them, defaults on notes, and so on and so forth. So that's why the deliveries are down, and we don't expect deliveries to pick back up significantly at all here in 2025.
Well, let's unpack that for a second, right? You can't build an apartment building overnight, right? It's not
right.
like you just put a seed and put a little bit of water on the ground, and before you know it, you got an apartment building growing.
That's right.
It takes a long time. There are alternative technologies like modular that you can use, but even with those technologies, you're still about a year out, give or take, to build an apartment building. And it could be 2 to 3 years out if you're building a larger complex, you're using stick frame technology, or doing a lot of site development and those kinds of things. What I've heard, and you and I have talked about this offline, is that there are very few permits being pulled for multifamily in the US. And maybe that's something
right.
for a viewer here to check, is if the market you've chosen, use the market hunter tool to confirm that it's a good market for growth, but then check to see how many housing starts, AKA permits, building permits, are being pulled in those markets. I've heard that there's an all-time low of permits being pulled. What that means is that the market condition that Hervé's saying exists here, which is true, is going to continue. You're not going to see new multifamily come on the market for the next couple of years because nobody is breaking ground right now.
Absolutely. And the thing is, again, all of this is going to continue to drive the demand for more units, which is going to cause rents to continue to increase. Again, continue to increase in the Northeast and the Midwest. And then you're going to start to see, I think, even bigger rent growth in those Sunbelt markets that had gotten hit over the past couple of years. You also have to tie this into the function of what's been going on into the single family residence market, right? Just single homes, where basically there's been a shortage of builds for single family homes. Some of it, a lot of the same reasons: high construction costs, higher material costs, higher interest rates. 80% of homeowners in this country right now have mortgages below 3.5%. They don't want to go ahead and sell their existing home to turn around and buy a new home in which they'd have to put a 7% rate on it. New developers, they do have a little bit more wiggle room than, let's say, a used home, where they can go ahead and allow you to buy down the rate a little bit, unlike buying a used home. And if you take a look in your neighborhood right now, there's just not a lot of homes, not a lot of inventory up for sale right now. I was reading an interesting article the other day where right now the fastest growing portion of the apartment rent market is millionaires. All right. So this is millionaires. I have a friend, case in point, he's selling his $1 million home in New Jersey after living there for 15 years. He's going to be renting for the next 18 months at a luxury apartment building in Philadelphia.
Yeah. In some ways, why would a homeowner go buy a new home at 6.5%, 7.5% interest rates? Why not just rent? Right?
Exactly.
Interesting. And listeners here, it's an interesting point. And that millionaire's probably not going to rent a C-class 1970s vintage apartment complex. He's going to rent something brand new build. So also consider asset class when you think about these things, because what's
Yes.
happening in A-class new build multifamily may not be the same thing that's happening all the way down the line. So it's also important to consider when the apartment complex that you're looking at either buying or that you already own, or you want to analyze a market, look at the different asset classes that are out there and where rent growth is happening in those markets, because you could see a tale of two cities in some ways.
Yeah, absolutely. Absolutely.
So are they all in? It looks like nationally rent growth is stabilizing. We've seen rent grow a lot over the last 5 years, and then it got a little flat because of all the new builds and because the rental economy got a little softer and things like that with everything happening in the world. But sounds like it's stabilizing. Is that what you're seeing as well?
Yeah, rent stabilizing. I mean, nationwide, right? Rent growth is literally 0.6%, right? That's what it was in the first quarter of this year. Now, again, we talked about which markets are seeing stronger rent growth than others because of supply of units and so on and so forth. We do expect nationwide that rent growth of 0.6% to increase nationwide again going into 2026. Of about 1.5% to 2.5%. Again, depending on where the markets are. I think the markets that are going to see the biggest rent growth on a year over year change, if you would take a look at a graph, for example, is those Sun Belt markets. If you take a look at a stock graph, where will we be buying? Even if you're just a fractional buyer of real estate, I would be a buyer right now going into 2026 because I'm confident about the job growth in the cities in the Sun Belt markets. That coupled with less supply in those cities coming to the market, I think you're going to see some really nice rent growth. You're going to start to see, maybe not necessarily in a hockey stick fashion. We have to keep an eye on what's going on in the economy and things like that. But if you are a typical value add investor, and Matt, we've been value add investors for many, many years now, but there's a difference in regards to what markets you want to be a value add investor. You want to be a value add investor in a market with a lot of strong job growth. Are Class A products going to excel well in markets with strong job growth? Yes, they will. But also, value add can excel well in a market with strong job growth. I will still continue to invest in the Midwest. I think Midwest is also seeing nice job growth, not perhaps maybe as strong as the Sun Belt, but nice kind of steady eddy, a little bit lower in rents versus the Sun Belt cities where you're going to see a little bit higher rents. But if you like value add in the Sun Belt markets going into 2026.
Love that. But you're still seeing markets like Austin, Denver, Phoenix that got overbuilt. We all know they got overbuilt. You're still seeing a recovery from the oversupply in those markets overall.
Yeah, absolutely. And that's where it is. It's recovery mode. Those Sunbelt cities are in recovery mode right now. The Midwest cities are not in recovery mode. They are in straight growth modes. You're talking about cities like Kansas City, Chicago, Cleveland, Columbus. They are in true Madison, Wisconsin, Milwaukee, Wisconsin. They are in true growth mode. Sunbelt cities, they are in recovery mode. You can win in either market. Let's be very, very clear. But you first have to ask yourself, what kind of investor am I? What kind of investor do I want to be if you're just getting started, right? And do you want to get something that's on the cusp of an upside swing? Or do you want to go ahead and invest in a market that's steady eddy? And that's the Midwest cities.
All right, so Hervé, you've given us a really good taste of where you're seeing the data of where we are now. So let's look forward on what you're seeing for the rest of the year and break out your forecast for where occupancy and where you're seeing multifamily investing going for the rest of the year.
So the high quality properties, Matt, it's a great question. High quality properties, they were at 88.3% occupancy at the beginning of the year. They're up 60 bips to now 88.9% this point of the year. Right now, we are forecasting, and a lot of the research says that occupancy should get up to about slightly over 90% by the end of this year. Remember, I was at the NMHC conference in Las Vegas back in January, and a lot of the commentary and some of the takeaways from that conference is exactly what we're talking about today. today. I met with a lot of brokers at that conference, commercial brokers in the multifamily world, and that was the main takeaway that, hey, there still needs to be a lot of conversations between buyers and sellers. We need to see some kind of stability in rates, but we do expect the transactions to pick up in the second half of 2025. Fast forward 6 months since that conference has been over, a lot of that, the takeaways from that conference, I have to tell you, I was just reviewing those takeaways from back in January. They still hold firm today. Wild card, obviously, interest rates. What was not taking place back in January at that NMHC conference was a strong discussion on tariffs like we are having today.
Yeah.
That they're on, that they're off, how high they're going to go, how long they're going to be in place. So that's bringing a lot of instability, insecurity, and concern in the markets. The direction of interest rates. It seems like the Fed would have cut rates if tariffs were not in the discussions, but because tariffs are, which at the end of the day is a tax, at the end of the day, the Fed can't cut rates in face of tariffs coming up, right? Particularly with some of our major trading partners and things like that. So that could put a little bit of damper on transactions in the second half of 2025. That being said, that's not going to damper what's happening with the underlying foundation of strong demand for apartments here in the US in the second half of this year.
So where are you seeing things move for some of the big bubbles in our population? You got the baby boomers on one end for folks aging out, maybe not want to own homes anymore. Maybe they want to cut their own grass or deal with home ownership because there's work in owning a home, right?
Yep.
There's that bubble on one end. And then on the other end, we've got these Gen Zs that are coming into the workforce. How are you predicting that's going to affect the multifamily market for the rest of this year and forward from there?
Yeah, I think that's going to add to the secular trend of growth in the multifamily market overall, right? The Gen Zs, another research article I read last week saying the average age of the first-time home buyer is now 38 years old. That's the highest it's been since that data started getting tracked back in 1981. Imagine that, 38 years old. People sometimes are already on to their second or third job by the time that they're 38 years old, right? That's pretty significant, right? And that decision by first-time home buyers waiting to make that first purchase has ripple effects throughout our apartment industry, right? Our multifamily apartment industry, right? And so Gen Zs is going to also drive demand for apartments on a secular basis. And again, like you said, baby boomers, aging of America, that's going to drive it as well. Practical point close to home here, my parents, after being homeowners for the past 55 years, are finally going to be moving out of their home and they're going to start renting an apartment in their early to mid 80s. And you're, I think, going to see more and more of that as the years go on.
Before, we talked about that there is a lack of building permits being pulled and a lack of inventory being put onto the market from builders that have built. There's stuff that was built a while ago being absorbed, but new builds, things being finished right now, paint drying while we're speaking, is not happening. What's the effect of that on the market?
Coming into the fourth quarter this year, we're expecting fewer than 80,000 new units to be delivered. Remember, there's about 130,000 in the first quarter this year. That's going to decline to 80,000 by the fourth quarter of this year. That's going to be a significant drop from previous years. Okay. And again, all that's going to do is drive rent growth higher in those markets that had seen rent declines last year. We talked about what's happened in the Sunbelt markets and things like that. And again, the reason why those fewer deliveries, the higher construction costs, labor and materials, higher interest rates, and so on and so forth. Shortage of workers in regards to this administration's immigration policies and the effect that's happening on the commercial construction industry in this country, and so on and so forth. So these are real concerns on developers. And unfortunately, Matt, what can exacerbate that situation if they really start implementing tariffs on the raw materials that are used to build not only multifamily, but also single family. When you start talking about putting a tariff of 50% on copper that we all know is used in plumbing for construction of multifamily, as well as single family, that can have a big impact and a real squeeze on margins for developers.
So all that means that we've got less competition as current owners or those buying existing multifamily, maybe not those building multifamily, but if you've got an existing multifamily or if you're buying one, you've got less competition and more pricing power as absorption continues to take down those properties that have already been built.
Yes. Absolutely. And that's why when you look at your landscape and we're approaching the second half of this year, going into 2026, you think about how does this table look like that has been set, right? Where am I laying my chips? Where am I going to do my investments? There are still great opportunities to be had out there. I'm not trying to scare folks away, even though we went over all these key drivers, but there are still a lot of opportunities out there. You just have to be thoughtful and strategic about it, right? Take a look at the rent growth going on in the markets. Take a look at the supply going on in the markets that you're looking to invest. And I think that's where you're going to see the winning opportunities. The winning opportunities, again, if you're interested in value add, go into value add where there is strong job growth. If you're interested in stabilized markets, obviously that's going to be the cities in the Midwest markets.
Everything we've talked about in growth in markets and in drying up of construction, where are you seeing all this taking rent growth through the rest of the year?
I see rent growth picking up by the rest of the year, again at 0.6% at the beginning of this year. I think at the end of this year, we end at about nationwide between 1 to 1.5%. Again, because the absorption of supply is going to continue at the same pace. New supply starting to slow down to 80,000 units from 130,000 units earlier this year. So I think those two factors are going to be the main drivers behind stronger rent growth in the second half of this year versus the first half of this year.
So in plain English, to break it down for everybody, rents are recovering. They're on the way back up. That's not in the media yet, guys, but the data is showing that it is. Vacancies falling and construction is drying up. All this adds up to a bullish market that's not being publicized yet for multifamily owners. This is going to create growth for those that are getting in early into this market that we're seeing right now. So let's bring this home for our investors. If I'm a passive investor, Hervé, what should I be looking for?
If you're a passive investor, you should certainly be looking for operators that have been doing it for a long time, that they have gone not only full cycle on the deals that they've had in their portfolios, but they've also experienced the cyclical peaks and troughs in this real estate market, that they've learned how to navigate dealing with lenders, dealing with the strict lending requirements, dealing with not only a low interest rate environment, a high interest rate environment. So experience with an operator will always serve you well, but even more so in what's been a little bit of a downturn for the industry. Once you've nailed down that operator, then you look at the strategic direction of that operator. Is that operator an operator that invests only in Class A multifamily? Matt, you and I, we know a lot of those operators. Or does that operator is strictly invest in value add? If he or she invests in Class A multifamily, where are they laying their chips for the next couple of years? It's going to be strictly in those Sunbelt markets like Phoenix and Dallas and Austin and Atlanta and Charlotte and Tampa and so on and so forth, or are they going into the Midwest? If they're going Class A into those Sunbelt cities, again, just be careful. You don't want to be into a city where there is an oversupply of units. Granted, demand is going to be strong and job growth is going to be strong, but I would lean into that operator that's going into a market that has strong job growth if he or she is targeting the Sunbelt markets. If you're targeting the Midwest markets, Class A, again, those cities like Columbus, cities like Madison, Wisconsin, that's experiencing a lot of job growth. Value add has to be in the cities with strong growth. If you even want to put rents on that, when you talk about value add, I'm going value add in a market where rents are around $1,100, $1,200. Matt, let's be real. You and I, we have faced value add in markets where rents are $700 to $800. Real tough to manage, tough to navigate. It's doable. It is doable, but you have to have a real close eye on your operating expenses as well as the vintage of your asset overall. So a lot of opportunities about. I am pumped up and excited about this market, particularly going into the second half of this year and going into 2026 because of the opportunities that I just talked about. Just got to be strategic about it. Avoid those landmines. Talk to good operators. Talk to people that you trust out there. Make the good decision.
So bottom line, Hervé, if somebody's on the sidelines, either as a passive or an active investor, with the right investment, now could be a good time to jump back into multifamily before the market heats back up. So final takeaways, guys. If you've been wondering if the bottom is behind us, the data is showing that it is. Supply is shrinking, demand is growing, and smart capital is starting to move fast. And I'll throw one more thing in there. There are distressed assets that are out there. And so and these are under the sheets, there's not blood in the streets in the open market, but there are good deals to be had that are maybe assets that are bought in the last couple of years that are being sold at a discount. If you're a passive investor tied in with the right operator, or if you're that right operator yourself, you want to jump in and find the right market, confirm the market that you're investing in has the right fundamentals. So right now, go and download the free market analysis tool that we have that Hervé developed for you guys, so you guys can pick the right markets and maybe make sure that it's not the wrong market, because that analysis tool will tell you if it's good or a bad market. Download that right now. There's a link down below, or go to our website, DeRosaGroup.com, to go and grab a copy of it. Again, it's the same tool that we use here at DeRosa, and it helps us cut through the noise and helps us make informed decisions for where we're going to invest. Until again, you guys join us here on this YouTube channel. Thank you for watching. Hervé, thank you always for joining me. Great. Let's have a great 2025 together, guys.